we have the COMEX options expiration in both gold and silver. And then tomorrow is the big day as far as I'm concerned. It's the large traders that are or are not standing for delivery in their December contract. This is one of the big deals when you see silver in backwardation still, meaning that the cost of silver today is worth more than it is out into the future. It's supposed to be opposite of that. It tells you that there's stress and strain within the market itself, and that there's a greater demand for physical metal than there is for the paper contracts that stand behind them. And this is what we've talked about for quite some time now. It started to really come to fruition, and this is a big one here. This December contract is certainly a big one.
Andy Schectman points out that the silver market is flashing signals unlike anything seen in years, and the December delivery cycle is at the center of it. Large traders must soon decide whether to accept physical metal or roll their positions forward, and the fact that silver remains in backwardation, where the spot price is higher than the futures price, indicates clear strain in the system. Schectman explains that this structure is the opposite of what a healthy futures market should look like. It reflects a stronger demand for real metal than for paper promises, an imbalance that has been building quietly and now appears to be surfacing with much greater force. Schectman also connects this market tension to deeper global shifts. He highlights how the new cross-border settlement system developed by several major nations allows trade surpluses to be converted directly into gold rather than routed through the US dollar. This model bypasses Western intermediaries entirely and provides participating countries with a faster, cheaper, and currency-independent way to settle oil, energy, and commodity flows. With expanded vaulting capacity in Hong Kong and another major facility underway in the Gulf region, Schectman believes these developments form an architecture that favors precious metals over fiat, increasing long-term pressure on physical supply, especially silver, which is already stretched by industrial demand. At the same time, Schectman notes a striking disconnect between what major institutions say publicly and what their top analysts quietly recommend. Retail brokers may have little awareness of precious metals, yet the highest-level strategists at large banks are now advising allocations to gold and silver that would have been unthinkable a decade ago. This guidance, he emphasizes, is directed at the biggest players, the same entities that have been moving enormous volumes of metal into U.S. vaults since last year. Add to this the growing concern over advances in quantum computing, which could destabilize digital financial systems, and Schectman argues that silver's importance as a tangible, outside-the-system asset is rising faster than most investors realize. Now, we present the clips from Andy's interview with Liberty and Finance. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
The COMEX options expiration in both gold and silver. And then tomorrow is the big day as far as I'm concerned. It's the large traders that are or are not standing for delivery in their December contract. And if they're not, they have to roll over their contracts or sell them, which keeps them as futures contracts, of course. And if not, they're going to stand for delivery. And I think this is one of the big deals when you see silver in backwardation still, meaning that the cost of silver today is worth more than it is out into the future. It's supposed to be opposite of that. It tells you that there's stress and strain within the market itself, and that there's a greater demand for physical metal than there is for the paper contracts that stand behind them. And this is what we've talked about for quite some time now. It started to really come to fruition, and this is a big one here. This December contract is certainly a big one. A couple other things that caught my attention over the weekend, down again, one of which we talked about. I don't know if I talked about on your show, but talked a little bit about on others, was that the Enbridge, which is kind of up from the shadows, over the last several years, the information that I would use or find to talk about the bricks was easier to find than it is now. It's kind of in the fog right now, if you will. And I think that's by design. They're keeping it quiet so as to not attract the attention of this administration and draw the cross-eyed look of President Trump. And one of the things, however, that did come to light was that UAE, United Arab Emirates, and China conducted another successful test of mBridge, a real-time test. For those people that don't remember, mBridge is the cross-border payment system that was designed by China, Hong Kong, Thailand, UAE, and, of course, the fifth full participant who came in a little bit later, Saudi Arabia. They're the big five, originally designed with the assistance of the BIS Innovation Hub. We talked how that went sideways when the BIS pulled out at the 12th hour. But one of the things that I find interesting, and I don't think should be overlooked, is this first trade was between China and UAE. Well, I don't think it should be overlooked that China, Hong Kong, and the UAE all run advanced precious metals markets where gold is traded in local currencies. And this enables mBridge members to convert trade surpluses, as we've talked about, directly into gold. And this bypasses the dollar entirely. This is the ultimate plan with the Shanghai Metals Exchange expansion of their vaulting system, the one that was just completed in Hong Kong. What's the significance of that? In order to take gold out of China, it has to come out of Hong Kong. So the first one was built in Hong Kong. So in an example like this, the UAE could sell oil, as an example, to China for the digital yuan over mBridge, which settles in 7 seconds, 98% reduction in fees, no U.S. or Western intermediary banks, no SWIFT. And then they can settle imbalances in gold first without converting into dollars and take possession in Hong Kong. And of course, the second vault is under construction, or will be very shortly, in Saudi Arabia. This is where it is heading, and I think that's a important piece. A couple other things that I noticed, UBS, and again, these banks are so full of BS at UBS. They're all full of it because they continue to raise their price targets. And their price targets are as useful as a mud wall, because they've been wrong continuously, yet, okay, fine, and they acquiesce and raise it. So now UBS says, well, we're going to raise our mid-year price target to 4,500, previously 4,200. Well, geez, thanks. I think that these banks that continue to raise their targets, if you go back and look what they were a year or two ago, it's almost kind of laughable. A lot of people will talk about it. I don't even think it really bears much consideration at all. They really don't want people to know what their real belief is, and that's why you have, it's funny because I have an account with Morgan Stanley, and the guy that I work with, he's a very good friend of mine, and he manages, a lot of money with Morgan Stanley. He's one of the biggest in Florida, and he lives in my neighborhood, and he wouldn't know a gold coin if it fell on his foot, yet his chief investment officer has advocated for 20% holdings in gold, sell half your bonds. And so, it's to me, these banks and the people who work underneath them really have no clue. But when you're getting Michael Hartnett, when you're getting, again, another comment from Jeffrey Gundlach, the bond king, saying that 25% gold is not overweight. And then, of course, Michael Hartnett, as we've talked about, he's the chief analyst of Bank of America. They're talking to people above, not the successful money managers who are managing $3 billion and are at the top of their game on retail. They're talking to the people who are bringing in all the metal into the United States. They're talking to the massive traders that are doing so. And they're saying gold and silver are being, in essence, by their actions, reintegrated into the system. To me, that caught my attention. So don't pay attention to what they're saying. Pay attention to what they're doing, unless you're listening to the very, very top analysts who are speaking to the institutional traders. One other thing that caught my attention was the Ethereum founder, Vitalik Buterin. Now I'm butchering that name, but it's interesting because he was giving a speech the other day, and he says, they've highlighted quantum resistance as a key element of the network's long-term roadmap. He says, this comes amid a risk of quantum computing advances that could potentially undermine current cryptographic systems. Ethereum races go to quantum safe. Speaking at DE Dev Connect conference in Buenos Aires, he says, the roadmap for Ethereum includes goals for the next 2 years, warned that cryptography securing Ethereum and Bitcoin could be vulnerable to quantum computing breakthroughs by 2028. And it's interesting to me that the guy that designed Ethereum is saying that quantum computing can do this. And he was inspired to say this because the test was conducted by Google Quantum AI using their Willow quantum processor. We've talked about the Willow chip, caught my attention about 2 years ago. And, Google previously stated that the Willow chip could do in under 5 minutes what the world's fastest supercomputer could do in 10 septillion years. Now, I didn't even know what that meant. It's 10 to the 25th power. And so when you talk about reasons to, I think more than ever, to consider having something outside the matrix, outside the system. You got the guy that developed Ethereum, where it seems like everything trades on the Ethereum network. It's the rails of so many of the crypto tokens and really the rails of the entire system. Much of it, anyway, goes to show how naive I am with cryptocurrency. But the point of it is that when you get the guy that is the designer saying that within 2 years you could see problems or the ability of quantum computing to hack and or steal Bitcoin and Ethereum, I found it to be very, very concerning and interesting. These things you don't hear about in the mainstream, but whatever, nonetheless.
A seismic shift is unfolding in global markets as the decades-old yen carry trade begins to unravel under Japan's tightening monetary policy. A development Andy Schectman warns could become one of the most destabilizing events of this cycle. For years, investors tapped near-zero interest yen, converted it into dollars, and funneled trillions into U.S. equities, bonds, crypto, and emerging markets, earning returns with virtually no borrowing cost. That model is now breaking. With Japan raising rates and the yen strengthening, institutions holding roughly $1.1 trillion in U.S. treasuries must unwind their positions by selling American assets and repurchasing yen at far higher levels. This reversal is already lifting U.S. interest rates and triggering what Schectman describes as the early stages of a systemic chain reaction. The implications stretch far beyond currency markets. Schectman argues that decades of artificially suppressed rates produced massive distortions across global finance, and the carry trade was one of the largest beneficiaries of that environment. As Japan signals the possibility of further tightening at its upcoming December meeting, the risk of forced liquidations continues to grow. A rapid unwind would not only pressure stocks and bonds, but could also trigger a wider repricing across markets that have been propped up by cheap liquidity. With capital already shifting and volatility rising, Schectman and other analysts believe the end-of-year period could bring significant turbulence as the world adjusts to a reality where ultra-low-rate money no longer exists.
I want people to understand just how significant this carry trade truly is, because for years, the world was able to borrow a Japanese yen at 0% interest rates. So investors would borrow the yen in trillions of dollars. It's the biggest trade in terms of arbitrage that the world has ever seen. For a very long time, Japan kept interest rates at zero, and investors would borrow cheap yen, and then they convert it into dollars. And they use that money to buy U.S. stocks and bonds or emerging market assets or whatever they wanted in Europe or wherever. And whatever they earned in dividends and interest, these gains were pure profit because the loan cost them nothing. But now Japan has raised interest rates, and their currency is the rates and the value of the dollar strengthening. The trade has become uneconomical. You have 1.1 trillion in Japanese pension funds that are sitting there now, in essence, in a trade that doesn't make sense. And what's interesting is that now that the yen is strengthened, in order to convert back, they would have to buy yen at a higher rate when they bought it at a lower rate. And as they liquidate bonds in the United States, the treasuries that they're holding, 1 trillion of them, to bring it home to cover these positions, not only will interest rates go up here in the States, but all of that money going into the yen will push the yen up higher. And now you have a big, big problem. It's systemic. It's a chain reaction. And what the higher rates can do to this economy, and all of that money that is poured into treasuries and crypto and into equities is now beginning to unwind. And I think it's something people need to understand, that the selling pressure will trigger falling prices. And these falling prices, I think, will start to really, really very quickly put some of these trades upside down. And this is how you get this unwinding, this spiraling. And I think we're right there right now, because, that this yen trade represents trillions globally, and hundreds of billions of it sitting in the U.S. stock market alone. So I think people should watch this very closely. Their next meeting is coming up in December, and a lot of people think that they're going to raise rates again. And if that's the case, I think leading into the end of the year could be some massive fireworks. So those are the couple of things that I saw that caught my attention, and happy to take it any way you'd want. Japanese, I think it's their 40-year bond is at the highest rate since its inception. It's like 3.5% or real close to it. And so at some point, the Japanese will say, geez, we can buy our own bonds instead of getting, and the 30-year treasury is what? Barely 4%, right around 4.
The U.S.
Yeah, U.S. And when you figure in the fees and everything for switching, it doesn't make sense anymore. There's 1.1 trillion in U.S. treasuries that Japanese own. And so they're going to have to liquidate them to keep their accounts from blowing up, which pushes our rates up. And that's why the Fed keeps talking about, they've lowered rates, but the 10-year treasury is not moving. Why? Because they're strained. The rest of the world is selling treasuries. And when our largest creditor, Japan, decides to do this, and they have no choice but to do it, and unwind what amounts to the greatest piggy bank that the world has ever seen. And part of this distortion, we've talked about U.S. interest rates, but you could argue a 0% for 30 years nearly interest rates in Japan has been the greatest distortion, where you borrow at 0, take the proceeds, and buy things at higher levels. But it's unnatural. It's unnatural because the money borrowed at 0 is unnatural, which then flooded into our equity markets, our crypto markets, our bond market. And the unwinding of that is very dangerous. It's like, a balloon that's had constant air blowing into it, and all of a sudden there's a little tiny hole but the amount of air blowing in keeps it inflated. You pull that out and the whole thing could potentially collapse. I don't want to say that's what's going to happen, but it's that real. It is that real when you talk about what valuations are based upon taking that continuous injection of liquidity and speculative liquidity into our markets, pulling it out. It's something people should pay very close attention to into the end of the year, especially into the next meeting in Japan, where I think there's a better than likely chance that they're going to raise rates again. They have to defend their own country and have to kind of, let go of that peg that has enabled the United States and many emerging markets to experience a boon that wasn't natural. And Mother Nature always gets her pound of flesh in the end. That's the problem, is that the people who understand this understand it better than their financial advisors do, because why accept information from a very, very polished financial advisor if the financial advisor looks at the world diametrically opposed to the way you do? In other words, if you believe that there is something coming, for whatever that is, if you believe the dollar's in trouble, the markets are in trouble, geopolitically, whatever it may be, and the people that are managing your money don't, isn't that a conflict of interest? Isn't that silly? Because isn't what you're seeing globally, macro, big picture, isn't that really more important really in the scheme of things as to how it affects the markets? And so that's the frustration that I face all these years when the mainstream poo-poos it, but you look back at it and we've destroyed the mainstream, right? Gold and silver have beat the mainstream for all of these years and they won't even acquiesce. They say you're crazy. But wait, alas, you're getting at the highest level, 20, 25%. That's good, right? They never even gave in 5%, but that hasn't trickled down to the advisories yet. Like I said, my friend who he's in the Forbes top 50 money managers in the United States in terms of the amount that he manages, and he wouldn't know a gold coin if it fell on his foot. We talk about it all the time. Yeah, he's okay, fine, but he doesn't implement it at all. And his chief investment officer says, no, 20% should be in metals. The point of it is that when you have these beliefs and these feelings about being a contrarian, it's something that takes not only conviction, but it takes effort to make sure that your beliefs are right. And that's why so few people do it, Nottingham, because it's an inordinate amount of time and effort and, trust in yourself that you're right.
If current pressures continue building, the next phase in the silver market could arrive suddenly and with far more force than most traders anticipate. As contract deadlines approach, a growing number of participants may choose to secure actual metal rather than extend their positions, placing even greater strain on already thin inventories. If that happens, the pricing structure could flip sharply, with immediate delivery silver commanding a premium that widens dramatically and forces a rapid reevaluation of how much physical metal is truly available. A scramble for supply, especially from industrial users who cannot function without it, could turn what now looks like a quiet imbalance into a full-scale shortage event. This shift would unfold alongside a broader realignment of global payment systems that is slowly reducing dependence on traditional reserve currencies. As more nations route trade settlements through metal-backed mechanisms, the competition for bullion is likely to intensify, pulling additional physical supply out of Western markets. At the same time, influential institutions, acting long before public sentiment catches up, may continue increasing their allocations to hard assets, fueling demand at the very moment new technology risks raise doubts about the long-term stability of digital finance. If these trends converge, silver could transition from an overlooked commodity to a strategic asset whose availability, not its futures price, becomes the dominant market driver. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.